The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello everybody and welcome to another installment of the live advanced technical analysis course. Excuse me. This is webinar 3, and in today's webinar we'll be looking at two very important aspects of technical analysis. We'll begin our discussion with a focus and introduction to Japanese candlestick techniques, and then we'll move on to the discussion focusing on support and resistance, and also consider how we can combine these two approaches. Forex Academy is an online provider of educational facilities to traders of financial markets and cryptocurrencies. All the material in the Advanced Technical Analysis course is educational material with the purpose of introducing you to tools and techniques under the approach known as technical analysis. The goal is for you to develop skills that will improve both your analysis of financial markets as well as your ability to trade instruments in the financial marketplace. Just a few pieces of housekeeping before we begin. Please feel free to ask any questions throughout the course of the webinar. You can locate your chat box on the right-hand side of your screen. This is a live webinar. It is being recorded and will be placed in your members area once the webinar has concluded. Finally, we'll be hosting an extended Q&A session at the end of this live webinar that will provide you an additional opportunity to ask further questions. It will also give us the opportunity to perhaps go into a much more detailed discussion in terms of answering those questions, which will be for the benefit of everybody attending today's webinar. Just a quick overview of the course. This is the first week of a 3-week course that will complete the Advanced Technical Analysis course. Today is webinar 3. Tomorrow, we will complete the first week with the first of 3 technical workshops. This process will be followed through each week, including week 3, and week 3 will end with an end of course workshop. In today's webinar, we will introduce you to a very powerful technique known as the Japanese candlestick methodology. We will look at initially understanding and becoming aware and familiar with the components and dynamics of Japanese candlesticks. We'll then move our discussion onto understanding what we mean when we refer to the real body, as well as what we mean when we refer to long shadows. We will also then look at understanding the dynamics of a candle. This is very important for you to be able to take it to the next step, whereby you'll be evaluating price patterns. These will be broken down into the key patterns. We won't be looking at every single Japanese candlestick pattern in today's webinar. Alternatively, we've highlighted what we feel are the most significant and most powerful of the patterns, and they are broken down into 1, 2, and 3 line patterns. Over the course of the entire webinar, we will see how we can apply these various patterns. We'll then move our discussion on to looking at the important aspects revolving around support and resistance, understanding the importance of historic levels, identifying market dynamics at various support and resistance levels, and then look at putting it all together. The Japanese candlestick approach is a methodology of recording prices that was developed in the rice markets in Japan in the 1700s. You can therefore appreciate that this is a very old technique and perhaps regarded as one of the earliest processes that looked at studying markets in a technical analysis approach. It is a process that highlights the area principally between the open and the close, and this is the area known as the body. You'll see when we start looking at patterns that the area between the open and the close, or the body, is what primarily makes up the pattern analysis. The majority of candle analysis is focused on the body, as I've just stressed. Patterns are regarded as generally short-term signals, and they identify relationships between demand and supply. What these patterns won't do is they won't necessarily indicate what type of move is likely to follow, or give us the ability to potentially project where prices may ultimately follow. These will be down to various other techniques. The power behind Japanese candlesticks is that at any point in time, it gives us a strong indication of the underlying relationship between demand and supply. Support and resistance levels are price areas where clear decisions have either been made or forced upon market participants. Technical traders always need to be aware of these key levels of support and resistance, and we'll look at how we can capitalize from this information later in today's webinar. Let's now move our discussion on to the Japanese candlestick. What is a Japanese candlestick chart? Well, to understand and answer that question, we need to look at the components of a candlestick. That's a starting point. A candlestick shows the same four price plots used to construct a typical bar chart. In other words, the open, high, low, and close. If you look on the right-hand side of your screen, you'll see an illustration of two types of candles. One is an up day, in other words, where the close is higher than the open. The other one is a down day, where the close is below the opening price. Just to the left of each candle, you can see a typical bar chart. The bar chart is made up of an open, high, low, and close. The lower extreme of the bar chart is the low price, the upper extreme is the high price, the marking to the left is the open, and the marking to the right is the close. You can see that the Japanese candlestick highlights the exact same information. We have the low and the high, and we have the open down here and the close up at the same level. The principal difference is that the Japanese candlestick highlights the area between the open and the close, which we just mentioned is known as the body. Candlesticks are color-coded for up closes and for down closes. This is to differentiate the type of session that we've seen. So again, in the illustration in front of you on the right-hand side, you can see that we've highlighted a bullish body with a blue coloring and a yellow coloring or orange for a down day or a bearish day. This will become quite clear in terms of its relative importance when we start looking at patterns. So, just to extend the discussion a little further, we can see that a candlestick is made up of four price inputs: the open, high, low, and close. The candlestick is then also divided into three distinct areas. What we have is the upper shadow, which reflects the high of the day. We'll just make our reference to a day for illustrative purposes. We have a lower shadow, which will run through to the low of the day. And these mark the extreme ends of the price activity. The real body is the difference or the area between the open and the close. And that is, or those are, the components of a Japanese candlestick. Let's take a closer look now at what we need to consider when we look at the real body. Now, the real body, as a reminder, is the difference between the open and the close. What you have in front of you are two very different price sessions. Let's just run through what the observations are in these two prices. On the chart on the left, or the candle on the left, we have an open price down at this point, and the market closes strongly on the day, close to the high of the day's session. On the right-hand side, we have a market that opens at this level and closes not too far away from where it opened, roughly somewhere in the middle of the day's range. We can see that the market from the open looked like it rallied to this high, was unable to hold on to those gains, sold off aggressively down to those lows, found support down here to close at this particular level. The observation and following price action by looking at this type of activity can give you some strong indication of what the market is likely to do next. If we look at the candle on the left-hand side, the simple fact that the market has closed at the top end of the range, a significant distance away from the open, would imply that there's a greater degree of bullish confidence in the market. In other words, the sentiment factor is stronger. If we look at the chart on the right-hand side, the market opened at a particular level, rallied to a certain high, was unable to hold on to those highs, sold off aggressively over the course of the day, again unable to hold on to the lows, to come back and close somewhere in the middle of the range. If we consider the type of decision-making process that existed over the course of that day, it doesn't suggest as strong a sentiment driver as the candle on the left. Instead, this perhaps is a more indecisive environment, raising a question mark as to what the underlying direction is likely to be next. And this is essentially how we would look at the real body when applying Japanese candlesticks. The very important point from this discussion is that the size of the real body can provide useful clues regarding prospective, corrective, or reversal points in the market. Furthermore, the color of the real body can also be used to identify directional changes in any given market over any given time frame. You'll see in some illustrations that when we're dealing with a very clear uptrend, it makes sense that we are likely to see more blue candles than yellow candles. Likewise, when the market is trending down, the yellow candles or the yellow bodies should outnumber the blue bodies. When markets are in a more consolidative, indecisive phase, it is likely that we will see a more even balance between bullish days as well as bearish days. And this is one further additional advantage of the Japanese candlestick approach, is that from a visual perspective, you get a much clearer idea of where the balance lies with respect to demand and supply in a chart. Much clearer than, for example, if you were just using a bar chart. Understanding the idea behind a long shadow. Now, what you see in this particular chart is a market that has been trending down. See, the market moves lower. On this particular day, the market opens at this level, sells off aggressively down to this particular point over here, only to then see strong buying interest develop. The market closes lower on the day, down at this particular point. The interesting development about this long shadow, and this is the kind of information we can extract from very long shadows, is that the fact the market has rebounded strongly off a typical low, first of all identifies a potential critical support area. It also suggests perhaps that with respect to the downtrend that has dominated, from a price level, perhaps the market has moved too far from now, or at least for now, suggesting that bearish sentiment down at these levels might be relatively weak. This could then suggest the potential for a rebound. That is the kind of information that we can obtain. The final conclusion would be that a critical support level has been identified. If the market is going to recover near term, then it should hold above these support levels. If alternatively it is to resume the downtrend, then eventually we should see the market trade below these critical support levels. That then is the information that we can extract in terms of understanding what a long shadow is all about. Let's take a look at this chart to get a much better handle of what we mean by the dynamics of a candle. What I'm going to just do is, again, I'm going to read through price action on a day-to-day basis. We can clearly see that the market has moved in an upward direction from this level over here. On each subsequent day, the market delivers a strong recovery in price action, or a strong follow-through in an upward direction. These are large bodies They are strong candles, as we saw earlier, and they simply indicate that sentiment is bullish. On this particular day over here, let's call it day 1, we notice a slight change in activity. First of all, the size of the range has reduced in size. More importantly, the market has opened at this particular level and has closed higher on the day. So from a closing basis, the market has continued to move higher, but the level of conviction in terms of a push higher is clearly very, very different to the 3 previous trading sessions. That could potentially be an early sign of some waning in either momentum or bullish sentiment that we've become accustomed to up until this move. If we follow price activity on the following day, we notice that the market opens at a particular level, it moves up to a particular high, fails to hold on to those highs, sells off to this particular low. Once again, some buying interest develops to highlight a close that is at the same level as the open. Now, we had perhaps a question mark around this activity on the day in terms of what it means for a bullish continuation in the trend. The fact that the market has opened and closed and tried both the up and the lower end of the day's range means that a greater degree of indecision has now crept into the market. You may remember one of the aspects that we discussed when we looked at price action earlier this week. The observation of price and the change in the behavior of price is a very important indicator in terms of giving you an early warning sign with respect to market sentiment. This is exactly the same logic that we're applying over here. This particular session, where the open and the close is at the same level, is a clear indication of indecision. If the market is now indecisive instead of being bullish, then does that raise a second concern about whether we are in the process of seeing a change in sentiment? This is all confirmed on the 3rd day, where the market opens at a particular level, tries to rally, fails to hold on to those highs, sells off to then see a strong sell-off unfold and also result in a close that is closer to the lower end of the day's range. This activity is very clearly bearish and quite strong in terms of a reflection of market sentiment and really should not appear if the market is bullish. Therefore, on the close of this particular day, let's call it the 3rd day, we can then conclude that the trend has reversed and the risk is likely that, at least for the near term, price action will move in a downward direction. And this is really how we're trying to evaluate price action when it comes to Japanese candlesticks. The candlestick will give you an indication of a shift that is taking place in the market environment. It's a relationship or highlights a relationship between demand and supply. In other words, if we take a look at the information that we were able to gather from these 3 days, it was a clear indication that supply was beginning to outweigh demand, which ultimately would have a bearish effect on price action. Okay, so just to recap a few points that we've highlighted. A normal candle is called a strong line. This simply means that it represents a positive continuation of either a bullish or a bearish move. The smaller the real body, the weaker the line in terms of using the typical terminology that we would imply. Typically, this reflects consolidation when uncertainty exists and traders tend to square positions looking for a potential reversal or a correction. If we observe or witness lengthening shadows, these could herald the existence of some weakness in a trend. Furthermore, they would also identify potential support and resistance levels. What will become clear at a later stage is that the significant penetration into the previous line or the previous body is a potential reversal once the confirmation has occurred. And this will become apparent in terms of how we apply this when we look at what we refer to as 2 and 3 line patterns. What we're going to do now is we are going to run through the key Japanese candlestick patterns. Our focus will be firstly on the standard line, the spinning top, the doji, the umbrella reversals, the bozu line, an engulfing line, and star reversals. Let's start off with a standard line. Now, a standard line is essentially a candle that has a relatively large body. You can see two illustrations in front of you. One is a positive day. The one on the right is a negative day or a bearish day. The standard line simply is generally considered to be a continuation pattern. In exactly the same way as we've been discussing a strong line, this is what a standard line is. It is a reflection of strong commitment by the market in terms of pushing prices either in an upward direction or in a downward direction. So when we do see a standard line, we treat this as a continuation move. They have strong real bodies and smaller lower and upper shadows. They don't provide you with any specific clues in terms of a potential change in market direction or a change in sentiment. That is principally because these are regarded as continuation signals. They simply reinforce the existing directional bias. So that is a standard line. What a spinning top is a neutral pattern that is clearly distinguished by a smaller real body as opposed to the standard line that we just saw, and may or may not have longer shadows on either side of the real body. The real component of a spinning top is the relatively small body that we observe. Generally, when we see these types of patterns, the view is that the market is considered to be consolidating. The market has, at that point in time, very little directional conviction. Let's look at an illustration of some patterns on this particular chart. We can see during this phase that price action is moving in an upward direction. On this particular day, we notice or identify a strong candle. In other words, this can be regarded as a standard line. What the standard line is a continuation pattern, and the view is that price actions should continue to move higher. Remember what we mentioned about candles earlier, is that candles are not going to tell you where a market is likely to move to in terms of price projections. It is simply going to tell you that the probability at this point in time is that we are likely to see a continued move to the upside or a continued move to the downside, depending on whichever is the dominant trend. What we can also identify once we see these standard lines is levels of support or levels of resistance. Because the standard line suggests that the market should continue to move lower, we can draw the conclusion that for now we are unlikely to see prices move below the low of the standard line. In the same way, we can see now that the market has started to move lower. Over here, there is a strong sell-off. That is an indication that prices are most likely going to move in a downward direction. We can also identify resistance, in other words, prices below which the market should continue to hold. Again, another standard line over here, and eventually the market does continue to move lower. We notice that the market does penetrate the resistance level very briefly, is unable to hold on to those gains, and then once again starts to resume the downside. Likewise, if we look at the far right of the chart, we notice a standard line over here from a Japanese candlestick position that suggests that the market should ultimately continue to move in a downward direction. If we decide to go short, we can identify our resistance level and place our stop loss above that resistance, because the view is there's a low probability that the market will move above that resistance level. Therefore, Japanese candlesticks can also assist not just with a reading of the market and the trend, but it can also assist with your risk management. In this example, we can see spinning tops. If you recall from what we mentioned earlier, spinning tops are usually found in periods of consolidation in the market. Generally, they are characterized by smaller real bodies. And we can see an abundance of smaller real bodies during these phases where the market is consolidating. Once the markets start to resume the uptrend, you can see a predominance of stronger candles as the underlying market conviction continues to push prices higher. So essentially, spinning tops offer an indication that the market is consolidating. It is notably defined by smaller real bodies in terms of the day-to-day trading, and ultimately that consolidation should be resolved in the direction of the trend. The doji. This is a pattern that we actually looked at when we were looking at the components of a candle. And essentially what the doji is a candle pattern where the open and the close is at exactly the same level or very close to each other. This is regarded as a very important pattern. It is considered to be a reversal line or a reversal signal and warns of indecision that is creeping into the market. Remember, if we have been trading decisively, or if we've seen the market trading decisively in either an upward or a downward direction, and then suddenly a degree of indecision creeps into the market, that potentially is an early warning sign of a change in sentiment. So the doji is regarded as a very important pattern. The doji can be seen as a pattern that represents the area where the bulls and the bears meet. In other words, the opening and the closing prices are equal. In Japanese, doji means same as. There are essentially three types of dojis that we can see. One is a standard doji, and another one would be a doji where the open and the close is at the lower end of the range, and the open and the close is at the top end of the range. The additional benefit potentially of these latter two patterns is that this would be a more bearish signal because the market is closed at the bottom end of the range, and would also highlight an additional piece of information regarding potential strong resistance. The pattern on the right is perhaps a slightly stronger bullish implication to the market because the market has closed not just at the same level as the open, that's indecisive, but it has closed at the top end of the range. That would then also highlight a very key support level in the market. All three are doji patterns and provide a warning sign of a potential reversal, given the fact that they represent the market or they reflect the market that is now becoming more indecisive in its outlook. So let's take a look at some examples in the chart in front of us. We can see that two dojis actually present themselves over here. That would be a period of indecision. We can see the market has moved higher. What we never do in technical analysis is we never preempt anything until we get enough of confirmation. You may recall that the one tenet of Dow theory suggests or stated that a trend is assumed to remain intact until it has given us enough evidence that it has indeed reversed. Even though we've seen a doji, and that is an indecision, and that might raise some questions as to whether the trend may indeed be reversing, we ultimately see that it's simply just reflected a pause in the market. That indecision has been done away with, and the market has reestablished its bullish outlook. In this instance, where the market has traveled to a much higher level, we can again see the existence of two doji patterns. Here, this would also again be seen as a potential warning sign of a reversal. But we also then need to evaluate from price action whether we do ultimately see a reversal in trend. The sharp sell-off on this particular day reinforces that that indeed might be the case. That ultimately just leads to a correction. And again, this same logic is applied here, where we see a doji once again develop, following a short spell to the downside, leading to an uptrend. And we can follow the logic and the process in exactly the same way with this particular pattern. On this final day over here, we've seen the market move higher. We know that the market has been trending lower during this particular period. The reaction to the upside is potentially significant. The existence of the doji patterns could suggest that in terms of the move from this low to these highs over here, perhaps that move has run its course. The question is, does that represent the end of the correction relative to the down leg from this starting point? Ultimately, we see prices begin to move lower and establish or re-establish the bearish outlook in price action. So one can view dojis as reversal patterns, but also reversal patterns within underlying trends. So if they reverse a correction, that is still a reversal pattern. If they ultimately lead to a reversal in the principal trend, then again, that is a reversal too. Let's now move our discussion and our focus to the umbrella reversal. There are two distinct variations of the umbrella pattern. What we will do is, once we've looked at these patterns, we will focus on where we should be placing the emphasis on, one from a bearish reversal, one from a bullish reversal, and look at the significant impact and effectiveness of those two specific patterns. We have a hanging man, which appears at the top of a market, and a hammer, which appears at the bottom of a market. What we will focus our attention on is the hammer, which reflects a much more powerful bullish reversal signal than the hanging man, which appears at the top of the market. The principal characteristic or the makeup of an umbrella is a pattern that has a relatively small real body with little or no upper shadow. The lower shadow should also be 2 to 3 times the length of the real body. The umbrella is widely regarded as a reversal pattern, but it is not necessarily seen as one of the strongest reversal patterns, so generally most people would apply a filter to provide an additional level of confirmation relating to the reversal. The color of the real body is usually not considered to be important. However, if, for example, we were dealing with a bullish reversal, a bullish umbrella or a bullish hammer would be seen as an additional piece of reinforcing evidence, but it is not essential that the color needs to be in the direction of the potential reversal. So what does a hammer look like? Well, on the left-hand side, you have a hanging man. On the right-hand side, you have what we would call a hammer. The hanging man is a bearish reversal. The hammer is a bullish reversal. Typically, if you just think about what a hammer looks like, this is the appearance that we are, or the picture that we are dealing with. As I mentioned earlier, our focus is going to lie on the hammer as the more important of the two reversal patterns. We will take a look at an alternative pattern to highlight what is more significant in terms of reversing a bullish recovery. At the top of the market, just to recap, this pattern is called a hanging man, while at the bottom of the market, it is known as a hammer.